Will millions lose their homes by 2026? The hidden housing risk. What if the next financial crisis doesn't begin on Wall Street, but quietly in neighborhoods across the country? Not with stock market panic, not with dramatic headlines, but with something slower. Foreclosure notices, rising monthly payments, and financial pressure that builds quietly over time. Right now, most people believe the housing market is stable. Home prices remain elevated. Inventory is still relatively tight in many regions, and compared to 2008, lending standards appear stronger. But beneath the surface, certain indicators suggest that the foundation may not be as solid as it seems. Over the past few years, interest rates have risen at one of the fastest paces in decades. Between 2020 and 2021, millions of homeowners locked in historically low mortgage rates. Some secured rates below 3%. But those who purchased later faced a very different reality. Higher home prices, higher borrowing costs, and significantly higher monthly payments. Today, mortgage rates remain elevated compared to the pandemic era. Refinancing options are limited. Insurance premiums have increased in several states. Property taxes are rising in certain regions, and everyday living expenses remain under pressure from inflation. For households that stretched financially to buy at peak prices, even small changes can have a large impact. This does not automatically mean a collapse is coming, but it does mean vulnerability is increasing. One area attracting attention is adjustable-rate mortgages. While the share of risky loans is far lower than it was before the 2008 crisis, adjustable-rate products still exist. When these loans reset, monthly payments can increase. For some borrowers, that adjustment may be manageable. For others, especially those already carrying high credit card balances or auto loans, it could create strain. Historically, when housing payments rise faster than incomes, delinquency rates tend to follow. Another factor often overlooked is commercial real estate. Office buildings in major cities remain partially vacant. Remote and hybrid work models have changed long-term demand. Many commercial properties were financed at low interest rates several years ago. As those loans approach refinancing windows, owners may face higher borrowing costs. If commercial property values decline sharply, banks could experience stress. And when banks experience stress, lending standards typically tighten. Tighter lending reduces housing demand. Lower demand can soften prices, and price softness can change market psychology. Housing downturns rarely begin with panic. They begin slowly. Inventory rises gradually. Days on market extend. Price cuts become more common. Buyers become cautious. Then momentum shifts. So why does 2026 matter? Many loans issued during the low-rate environment of 2020 and 2021 will begin approaching refinancing or transition points over the next few years. If interest rates remain elevated into 2026, some borrowers may find refinancing more expensive than expected. At the same time, demographic shifts, migration patterns, and affordability constraints are reshaping demand. None of this guarantees a nationwide crash, but it does raise questions about resilience. Is this another 2008? Not necessarily. There are key differences. Lending standards have generally been stricter. Many homeowners hold significant equity. Household balance sheets, in some cases, are stronger than they were before the global financial crisis. However, one similarity stands out: confidence. Real estate is heavily influenced by sentiment. When people believe prices will rise, they buy confidently. When uncertainty grows, hesitation spreads, and hesitation alone can slow a market. From here, there are several possible paths forward. Scenario 1, a soft landing. Interest rates gradually decline. Inflation moderates. Refinancing becomes more accessible. Demand stabilizes. Prices adjust slightly but avoid sharp declines. In this scenario, housing cools but does not collapse. Scenario 2, prolonged stagnation. Rates remain relatively high. Affordability remains stretched. Transaction volume slows significantly. Some regions experience moderate price corrections. The market does not crash, but growth disappears for several years. Scenario 3, localized stress turning systemic. Specific cities or regions, particularly those with high investor activity or commercial exposure, see sharper corrections. Foreclosures increase in pockets. Banks tighten credit further. Consumer confidence weakens. This does not require a nationwide collapse to feel significant. Even localized crises can influence national sentiment. At this stage, no outcome is predetermined. The housing market remains supported by supply constraints in many areas. Demographic demand still exists, and policymakers are highly aware of systemic risk. But the environment has changed. The era of ultra-cheap money is over, at least for now, and housing markets built during periods of easy credit often behave differently once financial conditions tighten. Housing is more than an asset class. It represents stability, security, and long-term wealth for millions of households. When pressure builds in housing, it rarely stays isolated. The next 2 years may not bring headlines of collapse. They may bring something quieter: adjustment, repricing, realignment. Whether 2026 becomes just another year in the economic cycle or a turning point will depend on how these pressures evolve. For now, the signals are mixed, but the landscape is shifting. And in housing markets, shifts often begin long before most people notice. 2026 and beyond. What happens if housing pressure continues? In the previous analysis, we examined the visible risks forming beneath the housing market: rising interest rates, refinancing pressure, commercial real estate instability, shifting buyer sentiment. But what happens if these pressures do not ease? What if rates stay higher for longer? What if credit tightens further? What if confidence continues to erode quietly? To understand what 2026 could represent, we need to look beyond housing alone, because housing never moves in isolation. It connects to employment, bank lending, consumer spending, and overall economic stability. When housing slows, construction slows. When construction slows, job growth weakens. When job growth weakens, household income growth moderates. And when income growth slows while debt payments remain elevated, financial stress increases. Historically, housing corrections tend to unfold in phases. Phase 1 is denial. Sales volumes decline, but prices remain sticky. Sellers resist lowering expectations. Buyers hesitate but remain hopeful. Phase 2 is adjustment. Listings increase. Price reductions become more common. Negotiation power shifts. Phase 3 is forced selling. This phase is often triggered not by fear, but by necessity. Job loss, loan resets, cash flow problems. At that point, decisions are no longer strategic, they become survival-based. As we approach 2026, several structural questions emerge. First, what happens if mortgage rates remain structurally higher than the ultra-low levels seen in 2020 and 2021? A generation of buyers anchored their expectations to extremely cheap money, but cheap money was an anomaly, not a norm. If borrowing costs stabilize at higher levels, housing affordability may remain constrained for years. Second, what happens to investor-owned properties? In many markets, investors purchased single-family homes during the low-rate era, betting on continued appreciation and rental growth. If rent growth slows while financing costs remain elevated, some investment models begin to look less attractive. Investor pullback can amplify price softness in specific regions. Third, what role do banks play? Bank balance sheets are heavily tied to real estate, both residential and commercial. If property values decline meaningfully in certain regions, capital buffers can become strained. This does not imply systemic collapse, but it can trigger caution. And caution in banking translates to tighter credit standards. Tighter credit reduces transaction volume. Lower transaction volume reduces liquidity, and illiquid markets tend to experience sharper price adjustments. Another overlooked factor is demographic behavior. Younger buyers face affordability constraints. Older homeowners, many locked into low rates, may delay selling. This creates a supply imbalance that freezes market movement. When markets freeze, price discovery becomes difficult, and uncertainty grows. There is also the psychological element. Housing is deeply emotional. It represents security, family stability, long-term planning. When headlines begin focusing on rising delinquencies or falling prices in key metro areas, sentiment can shift quickly. Markets often move not when data confirms a problem, but when belief changes. So what could the period after 2026 realistically look like? There are three broader structural outcomes beyond the short-term scenarios. Outcome 1, a long-term normalization. Housing does not crash, it simply enters a multi-year period of modest growth, limited speculation, and tighter lending. In this scenario, the market becomes less volatile, but also less lucrative for rapid gains. Outcome 2 is regional divergence. Certain cities, particularly those heavily exposed to tech layoffs, commercial vacancies, or speculative buying, experience sharper corrections. Meanwhile, other regions with stronger employment fundamentals remain stable. The national narrative becomes fragmented. Outcome 3 is a credit cycle reset. If banking stress expands, regulators may respond with liquidity measures. Interest rate policy could shift. Credit availability could fluctuate. In this case, housing becomes part of a larger macroeconomic adjustment cycle. At this stage, none of these outcomes are predetermined, but what is clear is this: the housing market is no longer operating in the environment that fueled its rapid expansion. The era of abundant liquidity created pricing distortions. The current environment is testing which of those price levels were sustainable. The most important variable moving forward may not be interest rates alone. It may be household resilience. Can incomes keep pace with debt obligations? Can savings buffers absorb economic slowdowns? Can employment remain stable if growth moderates? These questions will likely shape the trajectory of housing beyond 2026. In past cycles, housing excesses built quickly and unwound slowly. This time may follow a similar pattern. Not dramatic collapse, not sudden panic, but gradual recalibration. And gradual shifts are often harder to detect until they accumulate. As we move toward 2026 and beyond, the housing market appears less overheated but more fragile. That distinction matters, because fragility doesn't always reveal itself immediately. It reveals itself when pressure persists. And the next few years will determine whether housing simply cools or whether it becomes the center of the next major economic adjustment.